Mistake number 1. Only talking to your bank. Look, your bank might know your name, but they're ultimately selling you their product. Are they the best fit for you? Maybe, maybe not. By only talking to them, you could be missing out on lower rates or, just as importantly, better terms and flexibility offered elsewhere by other lenders like credit unions or mortgage specialist lenders that only work through the broker channel. It's like only shopping at one store for everything. You're likely overpaying or getting a poor fit. Limiting your options is a costly mistake. Mistake number 2. House hunting before getting a real pre-approval. Getting a real verified pre-approval is different from those online calculators. Those are just guesses. A real pre-approval means a lender has actually looked at your income documents, your credit report, and your down payment details. Why is this a vital first step? Because falling in love with a $1.2 million Toronto home only to discover you're actually pre-approved for $950,000 is absolutely heartbreaking. And if you signed a firm offer, you'll need to come up with the difference in cash or find alternative, more costly lenders that will charge you much higher interest rates to lend you the money you need. Get the real verified numbers first. It tells you your true budget, usually locks in an interest rate for 90 to 120 days, and makes your offer much stronger, especially in competitive markets. Mistake number 3. Only focusing on the lowest interest rate. Okay, so this trips up so many people. That shiny, ultra low rate looks amazing, right? But what if it comes with tiny prepayment privileges, meaning you can barely pay anything extra towards your principal each year? Or what if it has crippling penalties if your life circumstances change and you need to sell or refinance before your term is up? Sometimes paying a slightly higher rate for much better flexibility, like the ability to pay down a bigger chunk without penalty, or take the mortgage with you if you're planning to move, is the smarter financial decision in the long run. Don't get me wrong, the rate matters, but the terms and conditions attached matter just as much. Mistake number 4. Ignoring brutal prepayment penalties. This one can genuinely cost you tens of thousands. Penalties for breaking your mortgage early, especially a fixed rate mortgage, can be huge. There are 2 main types of penalties. Variable rate mortgages often have a prepayment penalty of just 3 months of interest, which is usually manageable. But fixed rate mortgages often use something called the interest rate differential, or IRD. This calculation can be complex. It depends on where interest rates are when you break the mortgage, and can result in penalties of $15,000, $25,000, or even more, especially on larger mortgages common here in Toronto. Unfortunately, it's often buried in the fine print. Always ask your lender or broker, how is the prepayment penalty calculated if I need to break the mortgage early? Get a clear answer before you sign anything. Mistake number 5. Making a big financial change before the closing date. Okay, so you've got the approval. Fantastic. You're almost there. But hold off on financing that new car or bedroom set until after the house keys are officially in your hand. Seriously, lenders can do last-minute checks right before the final closing date. They often re-verify your employment and pull your credit report again. For example, a sudden new loan can throw off your debt ratios. Quitting or even changing jobs, co-signing a loan for someone, or running up your credit cards can raise red flags and put your entire mortgage approval at risk, right at the finish line. Keep your financial picture stable until the deal is officially done. Do you have mortgage-related questions? For a limited time, I'm offering a free one-on-one consultation. Just click on the calendar link in the description to book your time slot. I'm Alexander Gasenko, your trusted Canadian mortgage broker. Until next time.